If you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this. So, your $10,000 just lost $700 or $800 or $900 in real purchasing power, if not a lot more, actually more like $1,200 or $1,300 in less than a year. And that's the kind of thing that I think is really, this is what owning precious metals is all about. Looking at the futures right now, that's why I was glancing at my phone, and it's shocking. You have silver futures at $47.30, up fairly significantly today, and gold futures up $50 to $38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Then again, I mean, it's moving at a clip that just seems to be defying gravity. And now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. We talked about the chief investment officer of Morgan Stanley, shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills, those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50%.
For decades, the 60-40 portfolio, 60% stocks and 40% bonds, was the gold standard of investment allocation. That model is now collapsing. Morgan Stanley's CIO has shifted to a 60-20-20 mix, carving out a full 20% allocation for gold. Bank of America's Michael Hartnett goes further, proposing a 25-25-25-25 approach, evenly splitting assets between stocks, bonds, cash, and gold. His model has already outperformed traditional strategies in 2025, with gold's explosive 50% surge leading the way. These portfolio revolutions reflect a growing consensus. Gold is no longer an afterthought. It's becoming a core pillar of wealth preservation.
Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought the Prudentials, who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take, yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting Michael Oliver talking about meddling. Michael's a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point. But
Wall Street veterans are issuing predictions that once sounded unthinkable. Jefferies global equity strategist Chris Wood sees gold climbing as high as $6,600 in the near term. Bond king Jeffrey Gundlach expects $4,000 gold by year-end, warning that savers are losing purchasing power faster than interest income can keep up. Meanwhile, technical analysts like Michael Oliver suggest silver could reach $100 to $200 while gold breaks long-term resistance to set new records. Such forecasts from figures who once dismissed gold highlight how deeply sentiment has shifted. When insiders start betting against their own game, it's time to pay attention.
It's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising and rising against all the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system. Because in my mind, as much trouble as China is having, their yuan gets saved by gold. And the dollar, without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia, you'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system.
Gold's rise isn't just about investor demand. It reflects collapsing trust in fiat currencies. Against every G7 currency, gold is climbing. The U.S. dollar, weakened by relentless money printing, faces growing pressure from abroad. China, weighed down by economic troubles, is rapidly building gold vaults in Hong Kong, Dubai, Singapore, and Saudi Arabia, preparing for a new system where gold-backed settlements rival dollar dominance. This quiet shift could reshape global finance, especially if Beijing accelerates U.S. Treasury sales. In such a scenario, gold becomes not just an investment, but the foundation of a new monetary order.
Where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out. at least at 4% per year, but actually it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this. So, your $10,000 just lost $700 or $800 or $900 in real purchasing power, if not a lot more, actually more like $1,200 or $1,300 in less than a year. And that's the kind of thing that I think is really, this is what owning precious metals is all about.
While governments push digital dollars backed by U.S. Treasuries, the world's largest stablecoin issuer, Tether USDT, is hedging with gold. The company holds over $8 billion in gold stored in Swiss vaults and is investing directly in gold mining. Their new USA stablecoin, tied strictly to U.S. Treasuries, creates synthetic demand for government debt. Yet Tether itself is quietly converting profits into hard assets, not bonds. This contradiction reveals the truth. Those inside the system understand its fragility. Even as they promote dollar-linked products, they safeguard their own wealth with physical gold.
And it's only going to get more interesting. You bring in all of these stable coins. And I want to focus on a company like Tether, because Tether right now is the biggest stablecoin company in the world, and USDT. They're the ones that will make they're one of the groups that will make the digital dollars and back them supposedly with real assets, if that's what you call U.S. Treasuries. There's almost 200 billion of them floating around the world right now. I think the last I looked, it was 180 billion dollars. But where it gets really interesting is Tether just announced that they're launching a special U.S. dollar-backed coin, and they're calling it USA. And this will be the new digital dollar that will follow the rules written by the Genius Act, which is anything but genius. It's diabolically genius. It's very interesting to me that the CEO of Tether is a guy named Bo Hines, and until August, he was Trump's crypto advisor. He was writing these same laws, and 1 month later, he's profiting from them. It's kind of interesting. But these rules say that every USA stablecoin that Tether issues must be backed by U.S. Treasuries. It's a way to create synthetic demand for a asset that no longer has really the organic demand that they used to. But the interesting part is that, we're now being forced into we will be very soon, not just from the banks, but the credit card companies and all of these institutions will start using stablecoins to move money back and forth.
From central banks to Wall Street giants, from sovereign nations to crypto firms, everyone with deep knowledge of the financial system is accumulating gold. The traditional 60-40 model is being abandoned. Global currencies are eroding, and digital money experiments are tied to fragile debt. Meanwhile, gold and silver are breaking out, signaling profound shifts in how value is stored. The message is clear. If those who built the system are hedging against it with precious metals, everyday investors should consider why. The real question isn't whether gold will rise, it's whether you'll be prepared when it does.
And they'll all be backed by treasury bills. But what do you think Tether is doing with their own money? They're buying gold. They have $8.7 billion worth of gold sitting in Swiss vaults, and they're now buying gold mining companies. They were just at the Beaver Creek Gold Mining Summit. They made $13 million in profit last year. that profit is issued by the difference between the stable coins the treasuries they're purchasing back in the stable coins and the interest that they get to keep. So they don't apply that interest to the stablecoin holders. They get to keep it. And with that profit, they're converting to hard assets as fast as they can. And so, whether it be BlackRock, who manages 10 trillion, and Gunlock, whose reputation has been built on bonds, whether it be, as the only game in town, whether it be them now talking about buying gold, or Bank of America, or Jeffries, or Goldman Sachs, or all of these people talking, institutions talking about buying gold, or Tether. I guess central banks are hoarding it. Tether is hoarding it. And when everyone who knows the game is buying the same thing, maybe we should all wake up. I mean, that's what I've been screaming forever. It was just the central banks. Now you got the Western commercial banks talking about it. You got the bond people talking about it. You have this 60-40 mantra that has been ingrained in Wall Street lore forever. You have Morgan Stanley, chief investment officer. All of these people saying it. At what point do people start to actually believe? And that's the question that I guess ultimately will be answered. But again, when you start to see these people betting against their own game, what do you expect to happen? I guess I don't know. I guess we'll see what happens. But if it were me, I would think about that very, very seriously.